Now for a look at some of the movers getting our attention. Jenny Horne, host of Next Gen Investing, is with me. And of course, we'll start with Target under pressure today.
Yeah, and unfortunately, looking like we're starting things off for its fiscal year on the wrong foot. And we were looking at this name yesterday ahead of earnings, and I think there was a feeling of like, hey, maybe some of this negativity is priced in. Maybe we've already understood some of the weakness from tariff impacts potentially. But I think that this is a great example, especially for traders, that things can always go lower. You can always see a depressed name that continues to face some of this downward pressure, and that's unfortunately been the case for Target. We saw their earnings, revenue, and guidance all fall short of expectations as these tariff-related uncertainties and consumer boycotts really weighed on consumer demand. So this company saw its revenue drop about 3% year over year. That missed expectations. Transactions fell 2.4%. And that also just added to the fact that this name was seeing some weakened pressure this morning. So their CEO, Brian Cornell, did point to a series of factors that have negatively weighed on their sales. These include tariff uncertainties, lower consumer sentiment, as well as weak demand for consumer items, as well as the boycotting we've seen as a result of the company's decision to roll back its DEI initiatives, which has been met hugely with negative publicity across social media, something I even saw, months ago. So softer sales growth did also weigh on their bottom line. We did see adjusted first quarter earnings about $1.30 a share, lower than what the street had been expecting. And it's very hard to find the upside from here. Unadjusted earnings actually were better than projections at around $2.27. But they did say that they want to be clear. They are not satisfied with these results. They're moving with urgency to navigate through this period of volatility. And I think that perhaps needing to take a playbook from their pandemic era strategies when they were basically writing a masterclass on how to handle a strained or a more volatile environment for the consumer. Because Target at one point, this was one of our real leaders of retail. They had navigated a lot of their distribution centers quite well, the supply chain, and then it was like a slew of missteps, some of it being the private label mishaps where they were mismanaging the products they were selling. They were really big on some of these high margin items like TVs, home improvement type products that have since fallen a bit. And they did say they might have to increase prices when necessary, although they did stop short of endorsing broad-based price increases. So I think easy to see why this name is lower, and unfortunately why this is a great example of things can always disappoint even when the bar is set low.
Yeah, look, they're in a different position. You mentioned the DEI situation, and that's something people have been talking about. Target, for example, cut the sales outlook. They widened the full year guidance. TJX is the one I was really trying to get to. They had their outlook unchanged. So they didn't, Canada Goose pulled the numbers. But it's interesting that Target now has to widen the guidance for this uncertainty. It just doesn't bode well. The stock's down 6.5% today.
And I will say that at least maybe, like the one bright spot I could say to that is at least they gave guidance. We have heard from retailers that were just pulling it all together. So that's at least something. But I think that, yeah, right now in an environment where you're navigating through like these winners and losers of retail, it is so important to be able to maintain or at least give conviction on what the rest of this year looks like. But unfortunately for Target, they made their own enemies really when they pulled a lot of these initiatives that sent that very loyal consumer. I've always said Target has some of the most loyal consumers. People will tell you they love to shop at Target. That they've angered a lot of their enthusiasts and their loyalists. They have to bring back that very, very loyal and giving consumer. That I think they've lost a lot of those. So that has been unfortunate. And again, it just goes to show that right now in retail, there's still the winners, but there's the losers that feel like they're only losing more and more ground. Like Target, just incomparable now to Walmart, for example.
Yeah, good point. What about TJX?
So that's, to me, a winner. And I know it's not necessarily higher this morning, but there was still a lot to like about this report. And I think that you have to really dig to find basically what was causing some of this weakness, because sure, we did see same store sales showing some weakness, but they beat earnings. So, I mean, like a clean beat across the board. We saw they flagged some higher tariffs that could lead to softer than expected second quarter earnings. But all in all, this company reported adjusted earnings per share that blew past estimates, 92 cents. That did also show improvement on a year-over-year basis. Same-store sales did rise by about 3% year over year, slightly below projections that were calling for about a 3.1% uptick. So for the current quarter, they expect same-store sales to rise 2 to 3%, earnings to range between around 97 cents a share and $1. Sales guidance was roughly in line with about a 3% increase, but analysts had penciled in earnings per share of around $1.03. So that was higher slightly than the range given. So that outlook does reflect those uncertainties that they did say could be impacted by tariffs and some of the still unknowns. That said, though, they reiterated their guidance for this fiscal year, calling for same-store sales to rise between 2 and 3% for the year, earnings per share to fall between around $4.34 to $4.43. I also really like that TJX has historically given tighter ranges for its forecasts, which to me says there's also more conviction there. Like we said, Target widening out its forecast, which to me, if you widen the goalpost, it basically is just an easier shoe-in for you to eventually make that target. But that, for the case of TJX, I feel like they do tend to give a more narrowed range as far as their outlook, which is encouraging as far as conviction. I mean, so much to like here. Tariffs are a concern, and I think that you have to consider that they do have merchandise primarily based in the U.S., but they do have some exposure to international merchandise, which could see some price increases or price changes. And they also have very small margins. This is a discount retailer that doesn't have the same wiggle room as some of these higher cost just retail products. So I think that all in all, you look at this chart and you say this is a name that's pretty much sitting at all-time highs. Its 5-year weekly chart was pointed out to me by Rick Ducat yesterday. I mean, it's technically basically perfect. We've been in the most consistent uptrend on a 50 and 200-day moving average. But we've seen some degree of pressure as a result of the overall market at the beginning of this year. But I mean, all things considered, we're up 11.5% on the year and up 38% roughly on a 12-month basis. I mean, TJX's chart just continues to impress. It looks almost like it's in the AI space because it's been such an outperformer, Nicole.
Yeah. Good to see you, Jenny Horne. You know, we have to see whether people are going to be spending. If you have a higher rate environment and their credit card debt is higher because the rate's going up, auto loans, mortgages, I mean, the rate environment could really pressure folks. Also, in addition to tariffs, but the good side might be tax cuts and such. Jenny Horne, thank you. Good to see you.